Good morning, everyone. Thanks for joining today's session. We at BVA are always excited to welcome you to our bi-weekly webinars. And this is the webinar number 123 by Mr. Tarun Mahajan on the topic gaps and provisions of the Companies Act for valuation of convertible securities. We hope that you people continue to join our webinars and hope today's session will be as exciting as our previous webinars. With this, I would like to ask Mr. Ravi Chandran to introduce the speaker for today. Thank you.
Good morning, BVA members. Good morning, Mr. Tarun Mahajan. Mr. Tarun Mahajan needs literally no introduction, but Mr. Tarun Mahajan is a practicing chartered accountant, a registered valuer with an additional global credentials as a chartered financial analyst, CFA USA, and certified valuation analyst, CVA USA. He has been a member of the research committee on valuation set up by the Ministry of Finance, Government of India, and brings vast experience in valuing securities across India, handling assignments of varied size and complexity. As a faculty for valuation courses, he has trained over 6,000 practicing professionals, including CA, CS, and CMA, and making significant contributions to capacity building in the field of valuation. We welcome you, Mr. Tarun Mahajan. The floor is open to you.
Thank you, sir. Thanks a lot. I would just like to share my screen. Give me. Okay. So I hope my screen is shared properly.
Yes, sir.
Yeah. That's good.
Okay. Right. So good morning, everyone here, and a warm welcome to this continuing educational program. First of all, I would like to thank the Bangalore Valuers Association for giving me this wonderful platform to talk to the bright brains across the country. See, our profession of registered valuers is there for almost last 7 years. But even today, we often face one very familiar question or some of the very familiar questions, not just from our fellow chartered accountants or company secretaries or cost accountants, but sometimes even from the valuers like us, that when do we need a valuation? Still, this is a question, that when exactly do we need the valuation? Who can do the valuation? Who is eligible to do the valuation? What exactly need to be valued? I need valuation, but what exactly need to be valued? Do we need valuation now, or do we need a valuation at some point of time in future? And what should be the date of valuation? So these are some of the common questions which are frequently asked even now after so many years of establishment of this profession. And these questions actually especially becomes critical in case of valuation of convertible securities. Sometimes even I struggle with these questions because the provisions of specifically Companies Act 2013 and rules made thereunder are ambiguous, are a little bit blurred. In fact, recently I drafted a letter to be sent to the Ministry of Corporate Affairs seeking clarifications on these provisions, and in fact giving my suggestions for improvement of language of law so that the confusions may be removed. But I thought maybe on some of the points I may also be wrong. So better to discuss it with the people across the country, the registered valuers. And that's why I'm thankful for giving me this platform to discuss these points, these anomalies in the law. So we'll discuss it today. And in fact, I'll take your feedback. I'll take your input on these points. And maybe we can together send a representation to the Ministry of Corporate Affairs and to Security and Exchange Board of India, and maybe to CBDT also, because the tax may also be affected. So let's begin with some of the very basic provisions. Let me first give a disclaimer that I'm not a company secretary. I don't practice law. I just know the basic law around the valuation. So I know there are some very seasoned company secretaries are here. So definitely I would like to invite their inputs also throughout this session. At any point of time, if you wish to share your experience around the provision we will be discussing, so please feel free to unmute yourself or put your experience in the chat box. Okay, so let's begin with the very basic provision of Companies Act. Section 62, subsection 1, clause A. It says that whenever a company wants to increase its subscribed capital, those shares should be offered first of all to existing equity shareholders, that too in proportion of their existing paid up capital. And we name it as the right issue. The logic behind this law is to ensure that existing owners don't lose their control over the company whenever a company is up for raising more funds. They should be given the first chance. Their control should not be diluted. Not only their control is protected by this provision, but also the fair value of their shareholding is also protected by this provision. So you don't need a valuation whenever you come up with a right issue. In fact, you can come up with a right issue below the fair value also. And even if you make a right issue below the fair value, still the wealth of the shareholders remain protected. Let's take one very simple example. Look at this. A company has existing number of equity shares, outstanding number of equity shares equal to 1 crore. The fair value per equity share is rupees 500. So that way the wealth of the shareholders, combined wealth, is 500 crore rupees. Now company proposes to issue 1 crore more number of shares because it wants to raise 100 crore rupees of the fund. And it plans to make the issue at rupees 100 per share. Yeah, the right issue. 100 crore rupees company wants to raise, 100 rupees it wants to have the price, and that's why 1 crore number of shares it is planning to issue. A share worth rupees 500 is to be issued just at rupees 100, and as it is the right issue, there is no problem as such. We are assuming that only the resident shareholders are there, no non-resident shareholder is there in the company. Now, what is the post-money fair value of per share and in total? 500 crore rupees is existing wealth. 100 crore rupees is the further contribution. 600 crores divided by 2 crores is 300 rupees per share. So existing shareholder is losing 200 rupees per share. 500 fair value share comes down to 300, loss of 200. But on the other hand, on his right issue, he subscribed at rupees 100. Now the value is 300. So he has a gain of 200. Loss of 200 is compensated by gain of 300, and effectively the net loss is 0. This is right issue, hence there is no problem. What if these 1 crore shares are issued to some new people? In that case, existing shareholders will lose 200 rupees and the proposed investors will gain 200 rupees instantly. And that is why section 62(1)(c) is there, which says that if a company wants to make allotment to any person, which may or may not include existing shareholders. In fact, even if you are issuing shares to existing shareholders only, but not in their existing proportion, in that case also 62(1)(c) will be applicable. Then it says you need to pass a special resolution in the meeting of shareholders, number 1. So shareholders are giving their approval that, okay, it's fine that we are ready to lose the control because we don't have further money to contribute or we don't wish to contribute further money. They are ready to dilute their control, but still they are not ready to compromise the value. And that is why it is said that the preferential allotment must be made either at fair value or above the fair value, not below the fair value. So rule number 13, sub rule 3 of the company's share capital and debenture rules 2014 says that if you want to make allotment of securities, then it must be either at fair value or it should be above the fair value. If we look at the comparable section of erstwhile Companies Act 1956, Section 81 was there. Section 81 was also saying either you make right issue or you pass special resolution. Full stop. It was not saying anything about fair value. It was not saying anything about the registered valuer. So kind of it was left to the discretion of the management. But now government does not want to leave it to the discretion of management. And that's why they say issue at fair value. And management does not have the skill, and maybe they may be biased also. And that is why they say that, okay, that this fair value will be determined by the registered valuer. Management will not decide the fair value. So whenever there is preferential allotment, it should be at or above fair value, and the fair value must be decided by the registered valuer. But what is preferential allotment? So it excludes public issue, right issue, ESOP. In case of ESOP, people get done the valuation for the purpose of accounting, not for the purpose of filing it with the registrar of companies. So preferential issue excludes public issue, right issue, ESOP, sweat equity share, bonus share, depository receipts, which are issued outside India. Now, these provisions of preferential allotment and valuation by registered valuer are applicable not only to equity shares, but also to other securities. So Rule 13(2)(g) of the company's share capital and debenture rules 2014 says that price of the share or other securities to be issued on preferential basis, either for cash or for a consideration other than cash, shall be determined on the basis of valuation report of registered valuer. It is saying shares or other securities. And at the same time, rule also defines what is share and what are other securities. So it says shares or other security means equity shares. So if there is a preferential allotment of non-convertible redeemable preference shares, it is not covered under section 62(1)(c). You don't need a valuation report in that case. Though I have faced that sometimes some companies do approach in case of issue of non-convertible debentures or non-convertible preference shares that we are issuing these securities and we need a valuation report. So first of all, I say them that, look, you don't need a valuation as per the provisions of Companies Act in case of non-convertible debenture, non-convertible preference share. But they say, no, we need a report. I say, I'll happily do it. But have you ever faced anybody such situation where a valuation report was asked by the client for issue of NCD or redeemable preference shares?
Yes. Good morning, Tarun sir. Most
Good
of the
morning,
time
good
it is
morning.
because of the ROC requirement. ROC is not approving without the evaluation report. So they need to take. Even if we tell them it is not required, for ROC approval only they need to take.
Okay, understood. So the provision of the law is actually not requiring, but some of the ROCs may not approve the form filed by them past 3, and that is why they are asking for this report. Okay.
Also, sir, even we have come across section 62(1)(a)(c) says further issue of such shares. So shares includes equity and preference. So ROCs, some ROCs, they are of the opinion that since 62(1)(c) says issue of further shares requires valuation report, it may be equity or preference. So RPS also they will insist. Though we say that there is no logic, ultimately they like a debt, it will be paid. But still, there are issues. We come across many cases. That is one of the doubt. Now, in fact, I had a doubt. Now I got this rule. Shares and other securities means equity shares, fully convertible, partly convertible, debentures, or another security which will be converted. So non-convertible, I think this provision maybe I think I skipped it. You are always under the impression, sir.
Right. Thank you, sir. Thank you, Buji and Chandrasekhar sir for contributing. That's right.
One more small reading.
Yes,
I
sir.
think the regulation also requires, rule also requires that when you issue debentures, they should be properly secured, adequate security. I think that is the word used there. So that's why this valuation is required. That's what I understood.
Okay. Yeah. So yeah, in deposit rules, there is a provision that if the secured debentures are secured, they are not treated as deposit. But the value of security should be equal to or more than the value of debentures. So one thing you need to get valued is suppose some immovable property is mortgaged. So you need to get valued that immovable property so that you can escape the deposit provisions. But maybe they also want to make sure that the value of debenture is also calculated. Yeah, that may be a reason. Yes, you are right. That may be a reason they are asking for evaluation report even for debentures besides the valuation of the property which is mortgaged. Right. Okay.
Sir, but their valuation report in the debentures to ensure that amount will become secured, not the shares. So they want a property valuation. They're not equity valuation.
The law says property valuation, but
Yes,
ROCs
sir.
are having their own interpretations.
Yes.
So as you were also saying that share, they are thinking that it includes preference shares. While in the rule it is clearly written, share or other security means equity shares only, not preference shares, and fully convertible debentures, partly convertible debentures, or any other securities which would be convertible in or exchanged into equity shares at a later date. So, if somebody takes a strict interpretation, they can also say that even ESOP will be converted into equity shares. So it's a convertible security and that way it should be valued. But at the same time, we see that this is required only for preferential allotment. And while ESOP is excluded from preferential allotment.
Yes. ESOP is specifically covered under 61B. That is not required, sir.
Yes, sir. So the thing is now we need valuation for convertible securities only, whether it is compulsorily convertible or optionally convertible, whether it is fully convertible or partly convertible. It also include warrants, but definitely it will exclude ESOP. Now, the question is that suppose now coming to the main point that issue of convertible securities. So there are two questions. The first question is, do I need valuation of the underlying equity share? Or do I need valuation of the convertible security? Or do I need valuation of both? Second question is, do I need valuation at the time of issue of convertible security? Or do I need a valuation at the time of conversion of convertible security? Or do I need a valuation at both the times? So that is what now we are going to address. If you look at rule number 13 to H, just a second. If you look at rule number 13 to H of Company Share Capital and Debenture Rules 2014, it says that, okay, some alignment problem is there. Okay. Where convertible securities are offered on preferential basis, the first word, okay, just give me a moment. I'll highlight some of the words which are kind of creating confusion. Just a second. Okay, here we go now. So 13 to H says that where convertible securities are offered on preferential basis with an option to apply for and get equity shares allotted. So first, this word option is creating a confusion. Some people start thinking that this provision, this specific clause, clause H, is applicable in case of optionally convertible securities like OCD or OCRPS, but not for compulsorily convertible security. This option to apply and get equity shares allotted is creating confusion. There is a need of amendment in this language, and it may run like this, where convertible securities are offered on preferential basis with an option to apply for and get equity shares allotted, or where it is compulsorily convertible into equity shares. This phrase should be added over here. The price of the resultant shares. So now this is again creating a confusion. It communicates a message that you don't need to value the convertible security. You need to value only the underlying shares. And that is why some people are even practicing. Whenever a company issues warrant, what I have seen is that they just get valued the equity share, underlying equity share, but they don't get valued the warrant. I have seen situation, in fact, some of the clients approach and they say, okay, we want to get done the valuation of warrant. And whatever value for equity share you calculate, fair value per share, you say this is also value of the warrant. I said, no. Warrant is a call option. Its value will be entirely different than the value of the share itself. So after a lot of discussion, they finally said, okay, you write in the report that the company is in the process of issuing warrants. And for that purpose, we have been appointed to make valuation of equity shares. And this is the fair value of equity share. But they did not take the value of warrant from the valuer. What they are doing is just getting valued the underlying share itself. So I'll discuss that. In fact, the convertible security should also be valued. Then only the purpose of Rule 13, Sub-Rule 3 will be fulfilled, that it should be issued at or above the fair value. But this is creating a confusion that only share need to be valued, not the security, convertible security itself. Now, it gives two choices. Either you get done the valuation upfront at the time of issue of convertible security, or you get done the valuation at the time of conversion. 60 days prior to the date of conversion, your valuation report should be. But there is a word or, which clearly indicates that either you get done the valuation today or you get done the valuation later at the time of conversion, say after 5 years. But I'll discuss with you one situation where practically you need valuation at both times. Yeah, there are some situations that you need a valuation today as well as you need a valuation at the time of conversion, but this says or. And the greatest confusion is this provision to clause H, which says that provided that company shall take a decision that whether to take valuation report now or say after 5 years at the time of conversion. But in my opinion, it is not the discretion of company, rather it will depend on the terms and conditions of the convertible security. So this particular clause, if it is amended properly and several other paragraphs are added to this, all confusions will be removed. So the question is still there, that do I need valuation of equity or convertible security or both? Do I need valuation now or later or at both point of time? For that purpose, I have to answer this question. There is no single answer to this question. It depends on terms and conditions. So I'm dividing convertible securities into several parts. One is the convertible security where conversion ratio is pre-decided. 1:1 or 3:1 or 1:3, something like that. If the conversion ratio is pre-decided, this is one time. Where the conversion ratio is not pre-decided, rather than this security is convertible at fair value at the time of conversion. That means it says that today we are getting the money and we will convert this debenture into equity share at the fair value of equity share.
Tarun sir,
Yes, please.
I'm just interrupting because that you in the previous slide you told about the terms. Terms is also decided by the management.
Right.
So they can only hear if the proviso is saying that company shall take a decision, it is the management only who is making the terms.
Right. Right.
So sometimes it also happens they are not giving us the clear terms and conditions. They are not aware also, and they told us ki aap bata do what should be the case, or we have such kind of clients as well, and we try to make them understand also, but they are very adamant kind of, you can say. So it in that kind of situation it is very difficult to tell them ki sir aap abhi le sakte ho, whether you can take now or at the time of conversion, that you have to write down clearly in your terms. That also we
Right.
need to tell them. So in that kind of situation it is very difficult.
I totally agree, and I can relate with the situation I have faced. So sometimes they come up with very unclear terms. And I say, ki forget about valuation reading at these terms. First of all, there will be misunderstanding between the investor and the management, and there will be dispute at some point of time. You need to have clarity. So I'll discuss one case where they issued CCD and then say that it will be converted into CCPS, and then CCPS will be converted later into equity share, but at what ratio, it was not at all decided. So it was, I said, valuation is secondary. First, you need to be clear. You two guys need to be clear that what is going to happen in future. Something must be decided so that it is not left at the discretion of one of the two
Then
parties.
they will tell us कि मैडम आपका valuation आने के बाद हम लोग decide करेंगे. तो how we will do the valuation in that kind of situation?
And that's why this session is, ma'am.
Yes.
So we will clearly define what types of securities are there, and next time they approach you, you can say that this is the classification of securities and your security fits here, and that's why I need these terms. I have also faced these situations, and that's why I'm classifying securities. You'll get an answer by the end of the session. Don't worry. So conversion ratio is decided is one situation. It will be convertible at fair value at the time of conversion is other situation, that today we are deciding nothing. Whatever fair value appears after 5 years, amount received divided by per share price at that point of time will give you number of equity share. This is clear enough. There is no ambiguity in this. Number 3, neither they decide the conversion ratio, nor they say that it will be convertible at fair value at the time of conversion. They mutually decide a formula that after 3 years, after 5 years, fair value will be calculated using this formula, and accordingly the conversion price will be calculated. The formula takes some input which will appear at some point of time in future. Like fair value will be 10 times of the EBITDA. Now, whatever EBITDA appears after 3 years, 5 years, multiply it by 10 times and get the fair value. This type of conversion price. Conversion discount is pre-decided. So whenever next funding round happens, if we allot them shares at 1,000 rupees per share, we will allot you share at 10, 20, 30% discounts. You will be allotted shares at 700 rupees. So the conversion price is not decided, but discount will be 10, 20, 30%. Will give you that much discount.
I have one doubt here.
Yes, sir.
On the discount, as you said, they said that next round happens, 30% discount will be offered to the existing round 1. Now, when I go for second round, assume that I got a fair price of 800 rupees. We have to give for this first person 240 rupees is a discount. Now, assume that they're allotting for at the same time for round 2 and for round 1. One valuation report I got 800 rupees. As per that, I had to give 240 rupees discount. Do I have to give 2 reports, 800 and 640, whatever the minus 240, or only 1 report? They will decide. What will be the approach, sir? Same allotment at the same price.
I got your point, sir. So at the time of second round, you will need only one valuation report justifying the fair value of 800 rupees, because this 30% discount report management should obtain at the time of first round. So first round said this is unpriced round. Next round. So this is just a list. Don't worry, we are going to deep dive into each of the points. So, but in nutshell, at that time, you will need only one report justifying 800 rupees price, not 30% discount, because that has already been justified at the time of first round.
Sure.
We'll discuss that, sir. Then there are share warrants, and then there are convertible securities where conversion ratio is pre-decided, say 1:1. But there are added features, there are advantages or disadvantages added to that particular security. 0.0001% discount. This is a disadvantage given to the CCPS people. CCPS will be converted into equity share after 20 years only. And in this 20 years, we'll give you almost zero dividend while equity shares are enjoying the dividend. So this is a disadvantage. CCPS holders, suppose they don't have the right to vote as per the law provisions. So next 20 years, you can't vote, but equity shareholders will vote. So this is another disadvantage they are bearing. You may also offer them some advantages, like you have the down round protection or anti-dilution protection, or you can give them the liquidation preference. So this will also affect your conversion price or the conversion ratio. If time permits, this will be quite complicated though to discuss. If time permits, we'll discuss about that also. Let's discuss it one by one, starting from conversion ratio pre-decided. So I have kept ready some of the term sheets which were available with me. Look at this. So this is some startup and they issued, so we are discussing situation where conversion ratio is pre-decided. They issued pre-series A CCPS and face value is 10 rupees and dividend is nominal 0.001%. 20 years is the time period in which the CCPS will be converted into equity shares. And it says that subject to adjustment provided in clause 4.5 below, each pre-series A CCPS shall be converted into one equity share. So that means the conversion ratio is clearly defined as 1:1. This is fantastic. No confusion at all. Some adjustments will be there. That's a different story. Take another example. So this is again the situation where CCD were issued, which will be converted into CCPS. And later, the CCPS will be converted into equity shares. So it says this, upon holder of the pre-series A CCPS electing to convert pre-series A CCPS, each pre-series A CCPS shall be converted into one equity share of the company. So this again clearly defines that the conversion ratio is 1:1. Even in case of optionally convertible securities, this is OCRPS. And OCRPS issue price is there, that's fine. OCRPS conversion ratio, if you look at it, it says that each holder of OCRPS shall be entitled. The conversion ratio is clearly defined as 1:1. So these are situation for compulsorily as well as optionally convertible securities where a fixed ratio is there. In this case, in my opinion, you need valuation at the time of issue of the convertible security, obtain valuation of convertible security, as well as valuation of equity share. This is an advice given to the management of the company that if you are issuing convertible security where a fixed conversion ratio is there, then before you make allotment, obtain the valuation report, not only for the underlying equity share, but also for the value of the convertible security. And at the time of conversion of the convertible security, you don't need a valuation report. So this is not the discretion of management in this case to decide that we will get done the valuation after 5 years. No, you need to get it done today. You know why? Let's take an example. This is the answer to the question, but why this is the answer, we'll discuss that also. So let's take an example that you issue CCPS, which have face value of rupees 10. Issue date of CCPS is 31st March 25. One preference share will be converted into two equity shares. So 2:1 is the conversion ratio. And this conversion will happen on 31st March 2030. that is after 5 years. So what I'm saying is you need a valuation now, not in 2030, but in 2025. And if fair value of one equity share comes up to be rupees 1,000, then automatically the fair value of CCPS, which should also be certified by the registered valuer, is rupees 2,000. And as Rule 13 Sub-Rule 3 says that the share or other security you are issuing should be issued either at fair value or above fair value. So you are issuing other security, that is CCPS. And CCPS has a fair value of 2,000. That's why issue price of CCPS should be 2,000 or above 2,000 rupees. Imagine if management says that, no, we have decided to get done the valuation in 2030. There is no point in getting done valuation in 2030 because your conversion ratio is already decided. So suppose you are raising 1 crore rupees of fund. So 1 crore should be divided by 2,000. I guess 5,000 or 50,000. How many shares will be there? So 5,000 number of CCPs you should issue now if you are getting 1 crore rupees of the fund. And that's why this is needed now, not at the time of conversion.
Sir, in this case, valuation of equity share is required or valuation of convertible security is also required, sir?
Both. And in fact, it should be written in the valuation report of the registered value. I have seen situation where people say, no, you just give me valuation of equity share.
Yes, sir.
And maybe we will calculate ourselves valuation of CCPS. That should not be the case. In fact, they don't even calculate value of CCPS with PAS 3. They simply file the valuation report of equity shares, and even ROCs don't bother. What do they need is just an attachment, which is valuation report, which should be signed by registered valuer. Though the company is issuing CCPS, but the valuation report you are attaching is for equity share, it should not be there.
So what should
Sir,
be
then
written in our valuation report? In just one or two valuation report, you are saying?
In one single valuation report, in the
Okay.
conclusion, you will write both. So I have done the valuation of equity share, and the valuation of equity share is rupees 1,000. And based on 2:1 conversion ratio, value of CCPS is 2,000. This is simple case. That's why it is simply becoming double, but sometimes it's complicated and you need to make extra effort to value CCPS.
Sir, one more point. In this case, valuation CCPS we have to convert based on this coupon rate, period, and other things. Correct? 0%, whatever we get. Secondly, valuation of CCPS should come minimum 2,000, no? If it comes less than that,
No, that's what I'm saying. I have taken a base case where other things are not disturbing the value. There are no added advantages or disadvantages to CCPS holder. Just a 2:1 conversion ratio is there. But if there are added advantages given to preference shareholders, the value of CCPS fair value will not be 2,000. Maybe it will be 2,200. If some disadvantages are given to CCPS holders as compared to equity shareholders, then the fair value will not be 2,000. Maybe it will be 1,800 rupees. So that exercise you will have to do. I agree that exercise you'll have to do. But in this example, I am assuming that there are no added advantages given to preference shareholders. There are no disadvantages given. Like this company is not expected to pay dividend in next 5 years. So whatever dividend rate you are offering to CCPS holder, they'll not suffer.
yes, sir.
Right, sir.
Thank you.
Okay, this is the first case. Now let's talk about the second case, which is just a second. Where the securities are convertible at fair value at the time of conversion. No ratio is decided. Look at this. CCPS company has issued. CCPS has a face value of 10 rupees. 5% dividend is offered to CCPS holders. And then it says that the value to be offered for each investor CCPS converted to equity shares shall be lower than. Now, this is ambiguity in the drafting of this term sheet. This lower than thing should not be there, but let's not indulge into it. Shall be lower than the price offered by company for each equity share at the time of IPO. So what does it mean? It says that at whatever price you comes up with IPO, little lower than or let's say equal to that, we'll convert it. No ratio is decided. We have got the money, say 1 crore rupees, whatever price appears at that point of time, we'll divide it by that price. So this is convertible at fair value at the time of conversion. Take another example. So this company raised 30 crore rupees by issuing OCDs, optionally convertible debentures, which are convertible into equity shares in 10 years time. 6% coupon was offered. And it clearly said it is convertible at fair market value at the time of conversion as determined by an independent registered valuer at the time of conversion. No ratio is pre-decided. It is convertible at fair value at the time of conversion.
Tarun sir, in case of OCD, as there is conversion and redemption both option, so we have to do from breaks calls also and this also, na?
Yes, exactly. So we'll have to break down the security into two parts. One is plain debenture and one is option to convert into equity share. And both parts will be valued separately and they will be added together. So now let's again revise this thing. In my opinion here, at the time of issue of convertible security, you don't need a valuation report. Because what is the use of getting done the valuation today? Because it will be converted at the fair value after 5 years. So at the time of conversion, you should obtain valuation of equity shares and also the valuer should certify the conversion price or the conversion ratio. That is how many shares will be issued. Okay, even if the conversion ratio is not certified by the valuer, but you need a equity share valuation report at the time of conversion, say after 5 years. Today, you don't need a valuation report at all. But the problem is
in the
in
ROC filing, na, this thing will come.
Exactly.
Yeah.
So that's the point I'll discuss just a second. So look at this. If we go back to rule number 13.2G, just a minute, sorry. If we go back to rule 13.2G, it says that the price of the share or other security to be issued on preferential basis shall be determined on the basis of valuation report of registered valuer. Now, this is giving an impression that even on the date of issue of convertible security, you need a valuation report. Logically, you don't need a valuation report. That should be written in rule 13.2H clearly. But ROCs have started demanding that, okay, we need a valuation report now. So what I have seen is that some companies, they are obtaining a compliance report from a registered valuer at the time of issue of convertible security, which are convertible at fair value at the time of conversion. So in the compliance report, the registered valuer may write that, okay, the company has issued securities which require valuation at the time of conversion, not now. And that's why company is not taking a valuation report today. And still it is in compliance of rule number 13, sub rule 2, clause H and other relevant provisions. So this compliance report is obtained and it is attached with PAS 3. This is my experience. What have you experienced in such securities where ratio is not decided and convertible at fair value after some time? If you have some experience around this situation, please do share.
I am very confused at this time when they don't give us the conversion ratio or also, and it is also written ki fair value at the time of conversion would be decided. So I asked the management to give me something, some input, because I was not aware of this compliance issue report.
So nowhere in the company that or the rules it is written you need a compliance report.
Yes,
It should be plain simple that okay, we don't need valuation report, so we are not attaching it. Don't ask us. we'll give you after 5 years. But you can't say this to ROC. So they need something to be attached. So people have, devised a way that how to get rid of this problem. And that's why they have started doing this thing.
Sir, one is, as you said, they're taking a valuation report as a floor price, saying that they take a valuation report, saying that share securities will be issued at a price determined by the future led. But in case of eventuality, this will be treated as a floor price. Valuation report, they are taken at the lower side, very lower side. Normally, if you say any SHA, they'll have a downside protection, upside protection. They say valuation report based on the downside protection. This will be treated as a floor price. This condition is there in the SHA. That is one. Secondly, this compliance report, I was not aware. I think I got realized if ROS insists when it's not required, we can give an compliance report without numbers. I think this is an
You have
good
not.
takeaway. Good takeaway.
Okay. So look at this. The thing, what you are saying is the floor price and cap price. So usually this floor and cap thing is there either in case of startups or it is there in case you have NRI investors, because the FAMA does not accept that you are leaving something uncertain. So then they say that you need to decide a floor price. But it is not a compulsion. The management, suppose there are only resident allottees, no NRI is there. In that particular case, it is not a compulsion to decide a floor in the cap valuation. Investor and company wants to agree at a floor in cap, it's their choice. But law is not making it compulsory. They can simply be, if it comes down at 2 rupees or 10 rupees, whatever it is, we'll allot at 10 rupees. If it goes up crazily at 10,000 rupees, we'll allot at 10,000. They don't have to decide it. The only thing is you don't need valuation report now. You need valuation report only at the time of conversion of the convertible security. Take this example.
Yes.
You are raising 1 crore rupees of fund by issuing CCPS. Face value is rupees 10. Issue date is 31st March 25. It will be converted into equity share at fair value as at 31st March 30. These are the terms and conditions. So file a compliance report, or you file nothing with batch 3 if ROC is okay with that today, and later you obtain a valuation report. I mean, I'm talking from the perspective of company. Then the company obtains a valuation report in 2030 at the time of conversion. And suppose the fair value of equity share comes up to be 2,000 rupees, then 5,000 number of equity shares will be issued. It's like that. Now, the third situation. It says that there is a fixed formula. This is going to be really interesting. So this is again a term sheet. Company issued compulsorily convertible debentures, which will be converted into equity shares compulsorily in 2 years time period. Dates were also given. Each CCD was having a face value of 1 lakh rupees. Interest offered was 13%. 50% of the CCDs were to be compulsorily converted within 12 months. And remaining 50% CCDs were to be converted in 24 months. That is conversion to happen in 2 tranches. Coupon was 13%. That's fine. Now, they decided a conversion formula. Neither the ratio was decided, nor they were saying that it will be converted at fair value at the time of conversion. What they said is, if our return on equity for the last year was less than 15%, then the fair value to book value ratio will be 1 time. Whatever book value will be there will be deemed to be the fair value. Say if it is between 15 and 18%, or let's say if it is more than 28%, then the fair value will be 2 times of the book value. So this particular company, they came to me at the time of this conversion. They didn't come to me at the time of issue of these convertible debentures. They came to me, they issued debenture, they did not file any attachment with pass 3 and it sailed through. No problem at all was there. But on the day of conversion, before the day of conversion, they approached me and they say, okay, we need a valuation and you give us a fair value report. And this is our term sheet. So definitely your calculation should be based on this formula. I said, look, sir, you can appoint a valuer, but you cannot decide and impose the valuation approach or valuation method or valuation formula. It is the right as well as duty of the valuer to decide which approach or approaches should be used for valuation, which method or method should be used for valuation. If you are giving me a formula and then asking me to say that I am certifying a fair value, sorry, I can't say that this is a fair value. Now, Neeraj sir will be able to relate it. So while we were studying this CVA course, we came across a terminology called calculation report rather than saying it a valuation report.
Yes.
So that knowledge I utilized here. I said, look, sir, you give me data, I decide the approach, and approach will process the data and give me the fair value as output. But you are giving me data as well as you are giving me the formula or the machine or the approach. So I'm just doing the calculation. I'm not arriving at fair value. I will do this valuation for you, but I'll name this report as calculation report. I won't say it's a valuation report and I won't say it's a fair value. I'll say it is a calculated value as per the term sheet. Initially, they disagreed with this. After a lot of discussion, they finally agreed. And I gave them a calculated value. I said, first of all, you should have approached me at the time of me or any other registered valuer at the time of issue of this security. Okay, so I gave them calculation report and they filed it and it sailed through. That's fine. But what if the management would have approached me at the time of issue of this security? What would be my reaction in that case? How can I believe that this is a fair conversion formula? Maybe in this industry, normally in this industry, suppose the ROI or ROE remains between 10 and 15%. Suppose it usually does not crosses 15%. So I estimate that normally ROE will be between 10 and 15%. And normally in this industry, the fair value to book value ratio is 2 times. But these buddies, these people are saying 1 time. So current market multiple is 2 times. But in their term sheet, they have return is at 1 time. It means they are making a favor to the investor. If this kind of security is available to me or to some other party, he'll happily immediately buy this. That, okay, wow, I'll get shares at a very low price, at half the fair value, because 2 times should be the actual market multiple. And this term sheet is offering at 1 time. In my opinion, I'll just say that what I'm trying to say. In this case, at the time of issue of convertible security, obtain the valuation of convertible security. I'm not saying obtain the valuation of the equity share. Just obtain the valuation of convertible security, and this valuation should be based on fairness of the conversion formula, that how fair is the conversion formula. I'll give you an example also. And at the time of conversion, now we don't need a valuation report. Now what you need is just a calculation report, because formula is pre-decided. Take an example. Rupees 1 crore CCPS are issued. Face value is rupees 10 each. Issued on 31st of March 2025. Convertible at fair value as at 31st March 28. So it is a 3-year CCPS. And convertible at fair value at the time of conversion, but fair value will be 10 times of the EBITDA. So registered valuer won't be able to use his own approaches and methods, and he'll have to multiply EBITDA by 10 times and say this is the fair value. Now suppose a fair multiple is 20 times. But management has decided the multiple to be 10 times. That means they are offering a favor to the investors. They'll be offering shares at half of the fair value. So in this case, you need a valuation report of CCPs. You don't need valuation report of equity shares. And fairness of conversion formula. If conversion formula is giving, say, double, then the value will be double. What I'm trying to say is, if fair EBITDA, fair market multiple is 20 times, but management decided the multiple to be 10 times, that means they'll be offering shares at half the fair value. And that's why I'll say 10 rupees is face value multiplied by 2 times. Fair value is 20 rupees. So either you change your conversion formula to be fair, or take a certificate that this 10 rupees CCPS has a fair value of 20 rupees. So for 1 crore rupees of fund, you should not give 10 lakh number of CCPS. You should give only 5 lakh number of CCPS today. This is my opinion, because this is a very complex situation. And see, today the fair market multiple is 20 times, but after 3 years, the market multiple can also change. That's a different speculation. But as of now, this is the situation. Now, after 3 years, that is as at 31st March 2028, what do you need is just a calculation report. Suppose after 3 years, EBITDA per share is rupees 200. As per the pre-decided conversion formula multiplied by 10 times. So the fair value as per the pre-decided formula will be 2000 rupees. Face value per CCPS is 10 rupees. So the conversion ratio will be 200 CCPS will be converted into 1 equity share. Now look at this. You issued total 5 lakh number of CCPS divided by the conversion ratio of 200 means 2500 number of equity shares will be issued. See, if otherwise right from the beginning they would have offered a fair formula, it should be 20 times. So 200 into 20 times is straight 4000 rupees. 1 crore rupees of funding divided by 4000 fair value will also give you 2500. So if management comes up with a term sheet like this, where they have their own formula, number one, try to educate them that the better way is to either have a fixed conversion ratio, or to say that it will be convertible at fair value to be calculated by registered valuer. But if they don't agree, no, we want to have a formula, you are nobody to interrupt it, then say then the formula should be fair. If they agree to make the formula fair, fantastic. If they disagree, then you'll have to give fair value at premium or at discount, as the case may be. To which I'm sure practically they won't agree. And they will ask you, see, either you will lose this assignment or the only solution you can offer them is just to keep the situation blur. That means you say, sir, you obtain fair valuation of equity shares from me, and I'll give you fair value of equity share today. You file it with ROC. I'll not indulge into this formula. I'll not certify CCPS at all. So that will be actually playing around the rule, but not the right solution. The right solution is to calculate fair value based on fairness of the formula. You don't need valuation of equity share at all today. What do you need is valuation of the CCPS. This is not a very frequent situation, but yes, it is there. I have just displayed that. See another example.
Sir, Oh, can I interrupt a minute?
Just one more example and then we can discuss, sir. So here also, what did they do? This was a startup and they issued CCD and they said that CCD will be converted at the next round price minus some discount. But suppose next round doesn't happen in 36 months, where the next qualifying financing does not occur within a period of 36 months. Then the conversion will happen at 5 times the revenue. So look, they have decided a formula. And you need to check the fairness of this formula. Is 5 times too much? Is 5 times too low? And you'll have to use your professional judgment and look at the comparable deals which are happening around for this type of companies. Yes, sir. Please.
I think the same situation many times we come across. They have already decided. In your case, where 2 times of price to book ratio. So if the book ratio is 10 rupees, price should be 20 rupees. Sir. So
Right.
we're forced to give the valuation report at that less than 20 rupees, sir, because they cannot. So this big challenge everywhere because they all signed up. We
See,
don't have
that's the
solution.
whole. I'm sorry to interrupt. The problem is if you deny that no, this is wrong, I cannot certify, they'll go to someone else and someone else will certify, right?
Yes,
You will
yes,
lose the assignment.
Yeah.
So the practical solution is you ask them, don't obtain CCPS report, obtain, I'll just certify that this is the fair value. And now you know that how to deal with the situation. This is one way of doing it. But a better way is if all the valuers across the board are educated on this point, and if every good registered valuer starts denying that, sorry, we cannot certify it at par,
Then
they won't get valuation report from anybody. Now, this will take time to educate everybody on this point, but that will be the right way and then they will learn.
yes, sir. Thank you, sir.
Thanks. Now, the next situation where the conversion discount is pre-decided. Look at this situation. That CCD were issued. So initially in case of startup, what happens? They are so novice, they are so new that they are not even able to make their projections for next 5 years. And that's why whenever they go for the funding initially, some of them go for the unpriced funding round. Means we don't know what is our value today. You give us 1 crore rupees, 5 crore rupees, 50 lakh rupees, and later we will decide that how many shares to allot. Whenever next or whenever first priced funding round happens, we will allot you share at that time. And definitely you are an early bird, so you deserve a discount. So next round price minus discount will be your conversion price. This term sheet is saying if next round happen in 1 year, then discount will be 15%. If it happens after 1 year, then 15% plus 10% per annum. So if this conversion happens after, say, at the end of 3rd year, for first year, the rate is 15%. For second and third year, it will be 10%. So that is 35% discount we'll give you. Something like this. Okay, I'll give you another example. Look at this. So in this case, what happened? That company, they issued 97 lakh rupees of the debentures and some nominal interest was there. 5 years was the conversion period. And let's say that at the time of next qualified round, if it happens in 6 months, 10% discount, 12 months, 20%, 36 months, 25%, 60 months, 30%. Now, my question is, so first let's answer that when do you need a valuation report? At the time of issue of convertible security, you don't need a valuation of equity share. You don't need a valuation of the convertible security. But at the time of conversion, you need a valuation of equity share. Definitely you will need it because you are going for the next round, as well as for conversion of this round. For both purposes taken together, you will need a valuation of equity share, not of the convertible security at the time of conversion. But one major question is, who will check, who will vouch that the discount you are offering is reasonable one? The whole purpose of section 62(1)(c) is to protect existing shareholders from dilution in their value by offering shares at a lower price to new investors. If a company offers shares at a lower price to new investors, total value will be diluted, existing shareholders will suffer, new people will gain. This should not happen. That's the whole purpose of this section. What if to the new investor I say that for 1 year, after 1 year I'll have next funding round, I'll give you 60% discount. So you're offering a huge discount. Who will vouch it? Sir, management will vouch it. I got answer from some of the stakeholders that, okay, shareholders are passing a special resolution. They don't have objection. Why do you have objection as a valuer? I said, that's fine. They are passing special resolution. But special resolution is not full stop. Otherwise, Section 81 of Companies Act 1956 was saying just special resolution, nothing else. But this Section 62(1)(c) is saying that get registered valuers, report and take the fair value. So the purpose is defeated. This question is unanswered.
It means that you were saying shareholders resolution is only for giving permission to get the new members into the company, but valuation they cannot agree. Valuation has to be fairness. Is that the?
They are agreeing with the value also, but they are saying, look, we are unskilled people. Some skilled person certified that this is fair value, so we are okay with it. Go ahead.
So the fairness has to come from the independent valuation. So they cannot decide the price.
Right. In fact, even if shareholders are skilled, they may be biased in their own favor. Company may be biased in its own favor. So they have conflicting interests. That's why a third party registered valuer is required. So there must be something. Even if somebody comes to me and say, Tarun, what should be the fair discount to be offered? Now, it's a tough question to answer. It will be more based on the professional judgment rather than backed by some very powerful data. But this is something which need to be answered. So at the time of issue of convertible security, no valuation is needed. A compliance report may be filed for ROC purposes, but who will justify the discount rate? That's the question. So the registered valuer should justify, and there should be some guideline from MCA side also.
Sir, I have one more question.
Yes, please.
Initially, when I asked, sir, same question. Second round, they're issuing on the second year, 15% discount. So, value I got say 200 rupees. I'm allotting for the round 2. For round 1, I had to go to 15%. So, then I'm filing 2 pass 3. One pass 3 for first round, second, one more pass 3 for second round. Will the one valuation report of 100 rupees doesn't holds good? Then that holds good only for a second one. For first one, when I'm giving discount, you have to mention in the valuation 100 rupees fair value, 15% discount, 85 rupees fair value, or because allotment, because 15% discount arrived based on the 15% of the round 2.
Chandrasekhar,
Yes.
that's what Mr. Mahajan was telling, like calculation report. For cost case, you have to give a calculation report saying that it is as per term sheet, it is agreed, and we are giving calculation report. Along with the valuation report, calculation report can be attached and closed. That is what he gave a hint.
No, we just will listen.
In fact, I have one question here that if suppose both allotment happens on the same day, the second round allotment and the first round conversion, I know some people keep a gap that first they convert their existing one and then they issue the new one. In that case, you file 2 pass 3. But if the allotment happens on the same day, so is Form 3 designed like this, that you will need 2 pass 3, because in 1 pass 3 you can't write 2 values? Is it like that?
If the issue price is different, then the two pass 3 because the
Okay.
allotment.
Okay, understood. In that case, that's the solution, as sir is also saying what I was saying, that for the second round, the valuation report is sufficient. For the first round, you practically you attach the same valuation report. And management will offer an explanation that this is the discount which was pre-decided. If you want us to be certified by a qualified person, he'll give the calculation to us. That's the calculation report.
So for passive, we're attaching a valuation report of 100 rupees without mentioning the discount.
For both pass
management will
3,
give-
for
Yeah.
both pass 3, practically people are attaching the same valuation report. But as far as the first round conversion is concerned, tomorrow if a query arises that the fair value is 100 and why are you allotting it 85 rupees, then
Yes, sir.
you can attach the term sheet. So this is the term sheet, earlier agreed, and that's why this discount is there. No, you obtain a report. Okay, we'll obtain a calculation report and you keep it with you.
So we will say we'll give frequently, we'll give one more report. We'll call it a calculation report. We will not say fair value report.
But practically what is happening, I'm telling you that also. People are not obtaining any separate report. The same valuation report, which was saying 100 rupees, but you're allotting it 85 rupees, is attached, and you also attach the term sheet initially agreed.
Sir,
I'll tell you practically what's happening is they're taking the two valuation report, one from A, 85 rupees, one from B, 100 rupees. So that, let me complete, sir. They're filing two, one situation. Second situation, they're keeping a 3 months gap. Same valuer gives one for 85 rupees, one for 100 rupees. So how fair and how, I think, maybe
No, that's the wrong practice. That, see, keeping a gap and then forcing the valuer that you certify a different value will not be really a good idea. If I am the valuer, I'll disagree that within 3 months, why should I offer a discount and obtain a separate report? Yes, Rajeshwar sir, you were saying something, sir.
Thing is, pass through is STP, ROC, it will not go for ROC approval. People will be facing problem at the time of issue when they file MGT 14, that will go for approval. So pass 3, it is STP. The moment one professional is certifying, it is approved on the filing itself, on the immediate approval.
Rajeshwar pass STP, is it?
Pass 3 is
Sure.
STP.
Yes,
Sure.
yes, pass 3 is STP now. They are giving the
Pass 3 is
resumption
STP, only MGT 14 will
14
face
only.
problem.
Yeah, MGT 14 they are giving the resubmission, but in pass 3 you will do anything, they will approve. Later on they will give you the adjudication and all.
The purpose is that they don't want the company to
Delay
utilize the fund as soon as possible.
See how unfair. Pass is a major document. They're giving STP, then they're making a professional's life is miserable.
Okay,
Pass is
sir.
most
So
important.
that's the secretarial aspect which can be discussed separately.
Tarunji, is calculation of report allowed by registered valuers? Can we sign it off?
So actually, there is nothing like that. But what we are doing is, in this case, we are not following the valuation standards.
Yeah.
So even in the report, you will have to say, so usually we say that I am following ICI valuation standard or IVSC. Here, there you will specifically write. Just like in Rule 11 UA report, what do? We say we are not following valuation report, we are following the formula given by the law.
Correct.
So similarly here also, we will say that we are not following the valuation standard and it's not a fair value. So we have been assigned a task. Just like 11 UA, anybody can certify. Chartered accountant can certify, registered valuer can certify, merchant banker can certify, because nobody's name is written over there. So similarly for this situation, what do you need is a calculation, which is actually you don't need a report at all at this point of time. But if they force to attach something, that's the way out. And as a registered valuer, you can sign it saying that this is not as per the valuation standards. This is as per the formula given to me.
This formula is per the SHA. This value
As per
calculation
SHA.
as per SHA.
Yes.
Thank you, sir.
But that is the what we are saying कि हम रास्ता निकाल रहे हैं. But my question is, this fairness of the discount should be certified by an expert. That's the right thing to do initially. Practically हम क्या रास्ते निकाल लेंगे वो, that's a different thing. But what should be the right practice?
Sir, like when you're telling fairness of discount to be certified, hello,
Yes, I'm hearing, sir.
can we certify fairness of discount?
It should be. That's what I'm saying, that the MCA Rule 13(2) Act should give details of all these situations. And whatever discount is there based on, see, what is discount is basically cost of equity, right? If for 1 year I am offering a 30% discount, that means investor will get 30% return. It is as simple as that. So that is actually nothing but cost of equity. So when you do valuation of startup, what do? You initially arrive with CAPM, some cost of equity. Then you say that this is the startup, and based on my professional judgment, 10% risk premium should be added. Something like that. 15% is cost of equity as per capital asset pricing model. Plus 10-15% I am adding because this is a very risky venture. So accordingly, my discounting rate is 30%. So in startup valuation, we are already doing it.
So based on the cost of equity, we can certify this like discount rate, whatever they're offering.
Yes. And see, look at, you need a database then actually for benchmarking it. I mean, you look at historically, you subscribe to some of the startup data providers and you look at the actual genuine deals that in last 1 year, in this type of situation, what discount is offered. So that will be like the market approach.
Okay.
Right. Okay. Now, the next thing is issue of warrants. What is warrant? It gives the holder right, but not the duty to buy equity shares at a predetermined price on a specific future date. Warrants are similar to call options, where on a specific future date at a predetermined strike rate, you have the right to buy the underlying. If the price goes up beyond the exercise price, you exercise your right. If the price comes down, you let the option expire, you don't exercise it. Warrant is very similar to the call option. I'm using the word similar. It is not same. There are differences. At the time of issue of convertible, now the questions to answer, when to value and what to value. So at the time of issue of warrant, obtain valuation of equity share if it is unlisted company. Even for listed companies, you will have to do some exercise. Obtain valuation of equity share as well as valuation of warrants. Practically, I have seen most of the people. See, warrant is not something which happens frequently, but whosoever is issuing it, in most of the cases, they are just obtaining valuation of equity share as on the date of issue. They say the fair value of equity share today is 500 rupees. So we give them an offer to buy share at 500 rupees after 1 year, 1.5 years. And 25% amount we are collecting in advance and remaining will collect later if they exercise the option. So practically, people are not obtaining valuation report. Beware if any client approaches you and they say, do the valuation, and sometimes they insist that, okay, fair value per share is 500 rupees. You say fair value of equity and warrant is 500. No, absolutely not. Fair value of equity is 500, then fair value of warrant will be a different thing. It's a call option. It won't be 500, it will be less than 500, obviously. So don't certify this thing. Either you certify fair value of equity is 500, full stop. If they ask you to certify value of warrant, then use the black and shoes option pricing model and calculate the value and certify it separately. And they should obtain, in fact. That's the right way of doing it. At the time of conversion of warrant, you don't need a valuation because warrants are mostly at a fixed conversion ratio, 1:1 type. One warrant gives you right to buy one share in the company. So at that time, you don't need a valuation. Warrant also fits into that thing, pre-decided conversion ratio, 1:1. That's why initially you need valuation for both equity share as well as warrant, but later you don't need a valuation report, neither for equity share nor for warrant. Let's take an example. On 31st March 25, warrants are issued, which gives holder option to buy one equity share on 31st March 30. So this is not a listed company, because in case of listed company, SEBI says that the maximum tenure of warrants is 18 months. For unlisted companies, there is no such time period. So this is a 5 years warrant, and the exercise price is equal to the current market price. 1:1 is the ratio. You need a valuation now. Suppose fair value of equity share is 1,000 rupees. Then the fair value of warrant will be around 431 rupees. Say standard deviation is 35%, risk-free rate is 7%, dividend yield is 0%. Exercise price is equal to the current fair value. So current fair value is 1,000, as well as exercise price is also 1,000. Then the issue price of warrant. So fair value of warrant is 431. Issue price of warrant should not be less than 431. I have faced a similar situation of unlisted company where they wanted to issue warrants. And you know what did they say? They say this is 1,000 rupee share, and we have decided to charge to take 10% of the fair value today, 100 rupees. And if they exercise the warrant, then remaining 900 rupees we will collect whenever they exercise, say in 5 years, they exercise the warrant. This is a clear violation of Rule 13, Sub-Rule 3. People don't obtain this valuation, and the amount to be charged for warrant, they decide at their discretion. Even SEBI guideline is promoting it. SEBI guideline says that collect 25%. So 25% is 250, while fair value is 431. So you are making a favor to warrant holder. Mostly these are issued to the promoters or related entities. You are giving them an unnecessary favor by charging 10%, 25%, while the fair value may be more than this. So you should calculate fair value and check whether you are actually charging the fair value or not. When it comes to the conversion, you don't need any valuation report. Simply, if the price goes up to 1,500 rupees, obviously that fellow will exercise the warrant. Simply give him one share and you don't need a valuation report at this point of time. Sometimes what I have seen is that at this point of time, when warrant or convertible securities are converted and equity shares are allotted, ROCs may say, where is the valuation report? So what do people do? The valuation report they obtained initially at the time of issue of convertible security, they attach the same that we initially obtained. For your information, it is there.
Sir, one doubt here. Go back to your this one warrant only. You are telling like
this example.
Yes, sir.
You are telling fair value of warrant is 431. Generally, what happens when companies goes for share warrants, they'll keep fair value of equity shares 100 only, and on that they'll say 25% you pay now, and it should be converted into equity within, like, that call option should be exercised within 18 months. When you're exercising at that time, 75% should be brought in. That is, I think, issue mechanism. Not
exactly.
Then issue price is 1,000 rupees only, right?
That's the thing. Company is not issuing shares today. Correct. Let's say this is 18 months, or let's say SEBI allows 5 years. Okay. So let's ignore that part. So 1,000 rupees is fair value of equity. 431 rupees is fair value of the warrant. Today, correct, the company is not issuing equity share. Today, company is issuing warrant. Now, rule number 13, sub-rule 3 says that share or other security, if you are issuing, that security should be issued at or above the fair value. Today, you are not issuing share at all. Today, you are issuing warrant. So, warrant should be issued at fair value. People are playing this game crazily. Nobody understands it. They say, हमने तो exercise price 1000 offer करी है, so we are issuing at 1000. No, sir, you are not issuing share today. You are issuing warrant, so you should charge for the warrant properly. Right, sir?
Right.
This is an unnecessary favor to the promoter group. Tomorrow, if the price comes down, they won't exercise the warrant and they got the option. This is actually similar to the call option premium. So you charge a lower premium. If the price comes down, they won't exercise. Okay, their loss will be minimum. But if the price goes up, they will exercise it. So this is essentially call premium. You're charging them lower call premium and making them an unnecessary favor. And even big listed companies like the Adani group of companies in 2023, that cement company that issued to their holding company 20,000 crore rupees of the warrants at this 25% price, which was lower than the fair value. But even SEBI said charge 25%. You know, what does it mean? SEBI is saying that the fair value of warrant is equal to 25% of the issue price. But no, it's not like that. I'll tell you. I'm just coming to that point that people are misutilizing the SEBI provision. Listed companies, maximum time period of warrant is 18 months. Initially, 25% is charged. Even if the fair value is more, still practically companies are charging 25% only. Unlisted companies, no 18 months time is there. So like 5 years maybe warrant period. No minimum amount is receivable. So companies are even charging 10%. Look at this. I'll just first tell you about the SEBI provision. As I pointed out here, see, SEBI provision says you should charge at least 25%. If you read it carefully, it says you should charge at least 25%. That means it is just setting the floor. So it should be interpreted like 25% or fair value, whichever is more should be charged. That way, you will not only be in compliance with SEBI guideline, but also in compliance with the Companies Act. So if Companies Act and SEBI guidelines are not contradicting each other, then you should comply with both. If they are not contradicting at this point of time, SEBI guideline is saying at least 25% should be charged as the premium. And 13.3 is saying it should be issued at or above fair value. Now, if fair value is 431, so 250 or 431, whichever is higher, if you charge, you will be in compliance with Companies Act as well as in compliance with SEBI guidelines. This is one thing. Now, look at this. Take this example. 1,000 rupees fair value, 1,000 rupees exercise price, 1.5 years is the maturity. Suppose volatility is 60%, risk-free rate is 7%, dividend yield is 0%. If I apply Black and Scholes option pricing model here, the call option value. Now, see, I'm giving you one very, I find it very fascinating. You may or may not find it. It's a very fascinating comparison of call option and warrant. What I'm saying is that warrant can never be issued at fair value. It will always be issued below fair value. Any company issuing warrant will unnecessarily make a favor to the warrant holder. This instrument by default is designed like that. If a company is issuing warrant, it is doing unfair with existing shareholders. Full stop. That's the whole conclusion. I'll prove that. 1,000 current market price, 1,000 exercise price of warrant period 1.5 years, standard deviation 60%, all these inputs, call option. This is not warrant valuation. Call option value is 325, right? To become holder of call option, one should pay 325 rupees now. If this is my mistake, it should be 1.5 years. If option is not exercised in 1.5 years, premium is non-refundable. That's the nature of call option. Holder sustains a loss of 325. Now, next point is very interesting. If option is exercised, the holder pays whole 1,000 rupees. You go to the market and buy Reliance Industries Limited call option and pay premium now. Premium will not be adjusted at the time of exercise of option. You exercise the option and you need to pay whole 1,000 rupees, not remaining 675 rupees, sir. That's the basic nature of this derivative instrument called option. So you paid 325. If you don't exercise, it is lost. Even if you exercise option, it is again lost. Option premium by its very nature will always be lost. And you exercise the option, you will have to pay whole 1,000 rupees. 325 you paid premium, 1,000 exercise price, full exercise you pay now. So your cost of obtaining the share will become 1,325. This is call option. This is not warrant. But people has designed an instrument called warrant. And what do they do? To issue warrant, what listed companies are doing, to issue warrant, listed companies are charging only 250 rupees now because 1,000 is the price of the share. Unlisted companies forget about it. If warrant is not exercised in 1.5 year, the warrant holder loses premium of 250. And if warrant is exercised, the warrant holder has to pay remaining 75%. Just 750. In call option, you pay whole 1,000 rupees of strike price. Warrant is a different instrument. It says exercise price minus premium you paid, you have to pay. And then your cost will be 1,000. So what I'm saying is, effectively, the exercise price is not 1,000. The exercise price is just 750. Look at this. Underlying price 1,000. Exercise price also 1,000. Number of days are like 365 into 1.5, 548 days. 548 days. Interest rate is 7%. Dividend yield is 0%. Volatility is 60%. So the fair value of option is 325. But what you are saying is pay 325 now, and if you exercise warrant, only 675 you have to pay. Or pay 250 now, and you exercise the warrant, only 750 you need to pay. So exercise price is now 750. Call option is worth 325, but warrant is worth 434 because you charge 250 initially and you are saying only 750 need to be paid. So exercise price is 750, and that way call option was 325, but warrant is 434 rupees. A warrant worth 434 rupees, you are issuing at 250 rupees only, making unnecessary favor to new people at the disadvantage of existing people. In my opinion, in this case, this undue advantage of 184 rupees should become taxable in the hands of warrant holder. Section 56, subsection 2, clause 10 of the Income Tax Act. There are some High Court decisions saying that 56(2)(10) is not applicable in case of allotment, but it's an High Court decision, not a Supreme Court decision, not written in the law. So if you apply 56(2)(10) to the warrant holder, the Adani group of companies who were allotted 20,000 crore rupees of the warrant below the fair value, imagine the situation, the kind of tax liability they will have. They are getting a gift from the company. And look at the India's treatment of it. The warrant holder should book an initial profit of 184 rupees in his books of accounts. Because warrant by default is a security which is FVTPL, fair value through profit and loss, in the books of warrant holder. So he should say that I have booked a profit. But I've seen that practically people are not doing it. Whatever 250 they paid, they are showing only that on the asset side of their balance sheet. This is the biggest anomaly, clear violation of law, which has become a practice. So nobody is questioning it, neither CBDT, nor SEBI, nor MCA. And as a valuer, see, very big companies issue warrant. And when I said them this, they said, you are nobody. We have a big legal team, etc. So this is something which need to be addressed, need to be discussed with authorities. Yes, I will share the presentation. Don't worry, sir. Oh, sir. If there are any questions so far, let's
I have a question. Am I audible?
Yes, sir.
Yeah, so I just want to understand, while I understand this warrant and all, okay, it's whatever you have explained that, okay, we need to also value like call option only. But what is then difference between the partly paid up shares? So if the promoter really wants to grab this opportunity to invest part payment only, because in partly paid up shares, you don't need to do all this, right? So, or like, because in partly paid up share also you have been given the option that, okay, you can pay a part amount and the balance may be called up after some point of time.
Section 10, subsection 2, Companies Act 2013,
Hmm.
that the remaining amount, which is
Hmm.
uncalled,
Hmm.
can be enforced as a debt on the shareholder. So you pay 250 rupees now,
Hmm.
and later you say now the price of the share has came down. So I will not pay this amount. Suppose this is not a warrant, simply a partly paid share.
Hmm.
You paid 250 rupees, you were allotted shares. Now the price has dropped and you don't want to suffer loss and you deny to pay remaining 750 rupees. Company can enforce this 750 rupees on you as a debt recoverable from you in case of partly paid share. But if it is a warrant, then initially the instrument said you have a choice. If you wish, you pay remaining amount and get allotted the share. If you don't wish, forget about your 250 and we don't know you now.
Oh,
So
that's okay. That is for the downside. Okay, so I'm not talking about the downside. I'm because obviously if the promoters are going on for the partly paid up share because they just want to grab the opportunity at this valuation only because they know in future it's going to be higher. So in that particular point of time, in that particular case, when the value is going to be higher, okay. So in that case, the partly paid up shares, if we are issuing, then this entire because see nobody wants to really give the value higher than the fair value, right? Like the option value also, the promoter doesn't want to contribute, right? So whether the partly paid will solve the problem?
issuing partly bid up share will not solve the problem, sir, because warrant gives you an option. Do you want to buy? See, in case of warrant, initially you don't allot shares. In case of warrant, the issued and subscribed capital of the company will not increase on issue of warrants.
No,
And
but
the
sir, we
amount
are.
received on issue of warrant will be shown just as other equity.
I agree, but sir, here we are talking about the promoter case only, where they really want to contribute to the share capital only, and they want to increase the stake.
So in that case, they should pay 434 rupees, not 250 rupees.
No, but see, why should they go and do the 434 if the partly paid share option is available?
No, it's not a partly paid share, sir. That's
No,
the
no,
whole
no,
point.
sir, I'm just giving the bifurcation that if the warrant under warrant, if we are asking them to pay 434, and in the partly paid up share, it's only 250, and the promoter really want to increase the stake,
So
right?
that's so let me allow to differentiate
Yeah,
between
sure,
partly paid share and warrant.
sure.
Partly paid share has both upside and downside.
Hmm.
Warrant has only upside and no downside. So this need to be valued higher as compared to partly paid share.
No, I agree
Yes,
completely with
so
you.
that's the whole point. If there is no downside and there is only upside, you are allotted a very favorable instrument. And
I-
favorable instrument cannot come at a price of a normal instrument.
No, I
If
agree completely,
favorable,
sir.
it should be priced high.
I agree completely, sir. What about the warrant
Then
valuation and
what's the
all that
point?
stuff? So that's what if I want to advise the promoter that okay, if you really want to do something like this, if you want to really increase your stake by partly paying the money right now and balance in future, then go for the partly. That's what I want to confirm with you.
Exactly. Then you ask the promoter, then
Hmm.
don't ask for warrant. You
Ah,
take
so
partly paid share and
correct,
take the
Yes.
responsibility to
correct.
pay
So
remaining 750. Yes.
correct.
Yes.
Yeah. So that's what I'm saying that we can advise that, right? That okay, if you go with the partly paid share, then you don't have to pay this additional 150 or 200 rupees, right?
Exactly.
So
Exactly.
that's what I'm asking. Yeah.
Yes, sir. Yes, sir.
Okay.
Definitely.
So in partly paid
Definitely,
up
you can
shares, then
advise them that,
yeah.
okay, why are
Hmm.
you going for warrant? Better you go for the partly paid share.
Yeah.
You must be confident in the company that the price will rise.
Correct.
Yes.
Correct. Correct. Okay. Thank you.
You're right, sir. You're right, sir. In fact, this is very nice. And tomorrow, if somebody argues that why should I pay premium, then I'll advise them take partly paid shares.
Partly
Correct,
paid
correct.
option.
Yeah, yeah.
Good.
Thank you, sir. Thank you.
Thank you. Thank you.
Right. So this is the thing. This is the summary of the whole situation, what we have discussed so far. If the conversion ratio is fixed, today get valued equity share as well as convertible security. Tomorrow, nothing required. If it is convertible at fair value at the time of conversion, today nothing is required, but ROCs may ask something to comfort them. You can give compliance report, not a legal requirement at all. Tomorrow, issue just get valued equity shares. You don't have to value convertible security at all. If a formula is fixed, then today you need to get valued convertible security, not the underlying equity share, by checking the fairness of the formula. If formula is fair, convertible value security will be valued at par. If formula is making a favor, it will be at premium. If formula is disadvantageous to the investor, it will be valued at discount. Tomorrow, you only need valuation of equity share based on the formula. That will be the calculation report. If a discount is fixed, today the discount need to be justified by the valuer, not by the management. And tomorrow, you just need valuation of equity share based on the pre-decided formula, kind of a valuation calculation report. In case of warrant, today you need valuation of both equity as well as warrant. And tomorrow, you don't need a valuation. So that's the thing I wanted to discuss. Let me know if there are, you may have a question later at some point in time. So for that, my contact details are here. You can note down this number and you can send me your, if you have a query now, I'll be happy to solve it now itself. But otherwise later, if you study it properly and then you have more questions, you can send your questions on WhatsApp to me. As far as presentation is concerned, so I'll share the presentation with the management and they'll share it with all the registered participants.
Hi, Tarun. Shilpa here.
Hi, Shilpa ji.
I know that you're CVA. So have you taken up any CVA USA kind of assignments? How is your experience towards this course after post the course?
Okay. Not actually. So actually what happens that in USA, there are 2-3 types of certifying authorities. In India, only registered valuers are there, sometimes merchant bankers. But in USA, even a CPA equivalent to CA or CS can certify valuation. CVAs can certify valuation. And one more qualification is there, which I just forgot the name. They can certify the valuation. So the qualification, I mean, obtaining a certificate is not really that important, but obtaining the knowledge of the US market, like we have preferential allotment valuation. They don't have this. They have more valuation towards, the gift tax, estate tax, and more in the situations of divorce or similar other situations. So the requirement for valuation arises in different situations rather than as compared to India. They hardly have legal requirements for getting done the valuation just like we have. So understanding US market is important than getting the certificate. And obviously having a network over there is much more important than having a certificate. Having said this, if you ever get any US valuation assignment, that's a pure skill game. Here we have more to satisfy the regulatory authorities that, okay, if they are not happy, we'll do this, that. That's a pure skill game that you put your entire skill into it. You can't say that projections are given by the management and it's not our responsibility kind of thing. You should know the entire economy, the industry, the company. And based on that, you should create projections. Understanding business very well, talking to the management, and then arriving at a valuation which can be very well defended in a court is important. The quality of work and the value of commitments. is much more important over there. But as far as getting the assignment is concerned, you need a network. Just like in India, you need a network. There also you need a network. By qualification, you don't get even a single assignment. Not even a single. Not even the first one. You need a
Actually, the institute itself, the CVA, I thought, they could also help you, in getting some assignments.
They don't.
Okay. Thanks for the insights.
Right.
Thank you, Tarun sir, on behalf of Bangalore Valuer Association for giving us the insights. And this session was really helpful because I was always, and we all have doubts while we are preparing, and we are always of the opinion that we are doing something wrong.
Right.
In the last workshop also, you were thinking that. But yes, these kind of sessions are very important, and we get so much insights. Thank you, sir. Thank you very much.
In fact, I also thank all the participants for actively participating and listening with the patience. Early in the morning, it's really difficult, but thank you for being here. Thanks, everybody.
Thank you. Thanks a lot, sir. Nice session.
Yeah, Tarun, you were based out of which city?
Indore, Madhya Pradesh.
Indore. Okay. Thank you very much, Tarun.
Thanks to the technology that physical boundaries are not important now.
Yes.
Right, sir. All right. Thank you.
Thanks, Tarun. Vijay, you can end the session, ma?
Yes, ma'am. Thank you. Thank you, everyone. Have a nice weekend.